So in this lecture, we're going to continue going through the balance sheet for Monsta. Now we've looked at some of the other stuff in the balance sheet, and we've ended up on the inventory. So since Monsta is a company that sells inventory as one of their key components of their operation, this is a very important item on the balance sheet. The company sells truck parts, like accessories, to retail companies. So how the management manages that inventory is a huge indicator as to how well the management is doing with their job. Not every company has inventory. So you take a company like an airline. An airline doesn't have inventory because their job is to fly people. The only inventory they might have is some minor inventory for like the snacks. So that's an example that not every company has inventory, but our company does, and it's really important that we get this information correct, and it's clear to the user of the financial statement. Let's look at how inventory might be, the methods that management might have in order to come up with that inventory. So take one of the products we sell, floor mats. So the floor mats are purchased from the manufacturer by us for $10 in January, but then as you can see, as the year went by, they kind of creeped up in price. So we paid $10, but then later on we paid $11, then $12, and $13. So that's how much we're paying for them from the manufacturer. Now the retailer is going to purchase them with us at a marked up price. But when the retailer orders some floor mats, let's say the retailer orders some and we go and we grab a dozen or whatever. We don't know which batch we got them from. We're just grabbing a dozen floor mats and shipping them off to the retailer. And because we don't know which batch they came from, we don't really know what the inventory value is. So we're going to use some different systems that management can use to assume that the inventory is of certain values. One way we can do this is one system we can use is first in, first out, better known as FIFO. So the FIFO system says that we're going to assume that if the retailer, the customer buys something from us, we're going to always get them from the earliest batch. Now this is the method that most people think makes the most sense. However, another method that can be used is called last in, first out, or LIFO. Now the LIFO system has management assuming that whenever we sell something, we get it from the most recent purchases. So if we got an order for some floor mats, we would grab them assuming we're using LIFO and from the batches that came in the most recently. Now this doesn't make a lot of sense to some people, but when you think about it, it might actually work if the kind of inventory could become obsolete. So if you're looking at technology, a lot of times the newest technology is the technology is going to be utilized first, but it just really depends. And then a third type of method that management could use is weighted average. So with weighted average, we just average it up. We say take all our inventory, add it all up, and then divide by the quantity, and we get an average amount. And that method is used often too. Now this is a big deal because, well, let's face it. If depending on what the management decides to use, it's going to affect our profits. If the inventory is cheaper at first, then the cost of goods sold are going to be cheaper if we use the first in, first out method, right? Because the first in, first out method says we're getting the cheapest stuff sooner. And then if we use a LIFO method, then that method says that if we would have the most expensive cost of goods sold. If we look back at our balance sheet and income statement, the cost of goods sold is affected by the method that we use for our inventory system. So if our inventory system uses LIFO, FIFO, or average cost, The same goods are being sold, but it could give us a different value for that cost of goods sold. And that could ultimately, or that will ultimately, impact the profit of the company, not because of how well management's doing, but because of the method they chose to use. So it's important when we use the balance sheet that we understand if the company uses inventory as part of their core operations, that we really understand the methodology behind their inventory. Anything that has to do with inventory would be an important part of the analysis of the company. Notice that we have something called expenses in the balance sheet. They're not really expenses, they're called prepaid expenses. So a prepaid expense is something you pay in advance. You can only put things on the income statement that have been used up. So if you pay for something in advance, let's say you pay your insurance in advance, the insurance hasn't been used up. It's something you have available. Because it isn't used up, it's called a prepaid expense. Because it isn't used up, it can't be an expense. It has to actually be on the balance sheet as an asset. So everything you see in the income statement, every account you see that says expense, goes to the income statement, except for that one thing, that prepaid expense, that always goes to the assets. So we've gone through the current assets. Now we're going into an area that's called non-current assets. And the first one that we see is called fixed assets. So these assets are used for a long period of time. By a long period of time, we mean more than a year. So the first one we have is long-term investments. So this would be something we've invested in, maybe some stock or some property, but we're not going to get access to that investment. We're not going to sell it and get our return from it for at least a year. And this long-term investment could be several things. It could be property, it could be stocks that we're going to hold for a long time, it could be bonds we're going to hold for a long time. And so depending on what it is going to determine how we value it. So the $5,000 that we have valued there, is that fair market value? Is that the cost that we paid? Well, it's hard to say if we don't know what kind of investment it is. But those are options. So that's something we would want to know if we were analyzing this business, is how we came about with that value. Now next we have non-current asset called property, plant, and equipment. So this would be anything that we use in the business that falls under the category of property, meaning land that we use in the business, a plant or a building like a warehouse that we use in the business, or equipment that we use in the business. So maybe a forklift. If we purchased it 2 years ago, at the time of purchase, we wouldn't put it here and say property, plant, and equipment expense. This would be wrong. And say we paid $10,000 for it, right? Because you put it on the balance sheet at the price that you paid, the cost. They call that historical cost. This is absolutely wrong, and the reason it's wrong is because what we would be showing would be that the company used that property, plant, and equipment up all in that single year. However, this property, plant, and equipment, maybe it's going to be used for 5 years. If it's going to be used for 5 years, then why would we put it on the income statement for just 1 year? We need to put one of the 5 years here. So what we do is we call that depreciation. So we bought equipment. Let's say it was forklift, right? And we bought it and it cost us $10,000. But we're going to use it over 5 years. So if we're going to use it over 5 years, then what we need to do is only take one out of those 5 years as your cost. So let's go to a spreadsheet and kind of break this down. So let's look at this again. The cost of the forklift is $10,000. We can't take that $10,000 as an expense in the year in which we bought it in the first year, because we're going to use it for 5 years. So we can only take the piece of that we used for that 1 year. So one out of 5 years is $2,000 as our expense. So the expense is $2,000 for that year. So if you look at the income statement, you'll see that only $2,000 is used as our depreciation expense. However, the value of that equipment on the books is now $2,000 less because we used up $2,000 of it. So our book value is going to be the cost that we originally paid, called the historical cost, minus the expense that we've taken, all the expenses we've taken for depreciation up to now. So in the first year, our book value is $8,000. In year 2, we take another $2,000 expense, and so my book value is now going to go down to $6,000. As you add up this expense over here, the total of all the expense we take is called accumulated depreciation. All depreciation expense added up. So to get the book value, you take the original cost, they call it the historical cost, and you subtract out all the depreciation thus far. Now, that leaves us with $6,000, and eventually we'll get down to zero. It depends on the method we use. So then that year would be $4,000, and then we took another. We'll take another $2,000 in year 4. So a little bit over time, we're whittling down the book value, and at this point, it's $2,000. But then at the year 5, we take the rest of the depreciation, and the book value is zero. Now, is the market value of the forklift zero? Could you sell it for more than zero? Maybe, probably, actually. But what we're trying to get at when we look at depreciation and book value is not market value. What we're trying to do is match the period in which we used up the forklift with the period in which we take the expense. So we're just trying to match up as we use that asset up. Now, an important thing to consider here is all the flexibility management has. Now, they don't have flexibility on the cost, because the cost is considered how much they actually really for truly paid for it. They call it historical cost. And they use that because it's hard for management to manipulate, right? You can't really manipulate the cost that you paid. It's fairly straightforward. But management does have the ability to determine the useful life. How long will they use the forklift is a complete estimate. So there's some flexibility there. And then another element of this is called salvage value. So sometimes management will say, well, we think there's going to be a value of the asset at the end of its useful life. So that's what we think will be left over at the end of the useful life. And so that's going to have an impact on how much depreciation we take. And so the management could also have some flexibility there, because what is an asset worth at the end of its useful life? I mean, anybody's guess is good. So depreciation is not the value that the asset is worth at any point in time. It's the book value. And the book value is based on spreading out the cost that we originally paid for the asset over how long we think we're going to have it. So when we look at our balance sheet, we need to understand the importance of that. In this case, let's make this a negative number. Makes it more consistent. But what that does is that helps us to see and understand the balance sheet, and we understand that with the property, plant, and equipment value, as we understand with accumulated depreciation, as we understand where management might have some flexibility, right? So all those things go into it. We also hopefully now understand that depreciation expense, there is some flexibility in how this depreciation is calculated, which allows management to maybe again have a method for having some kind of impact on the profit, that net income at the end of the day.